Inheritance tax planning in the UK, the mistakes that quietly destroy estates. Why most IHT planning fails in real life. Inheritance tax is one of the most badly planned taxes in the UK. Not because people don't care, and not because they haven't tried, but because people plan inheritance tax like it's an abstract exercise. They focus on what they own, they focus on values, they focus on who gets what. What they don't plan for is what actually happens in real life at the exact moment someone dies. Inheritance tax isn't really an asset problem, it's a timing and liquidity problem. An HMRC operates on a timeline that does not care about grief, practicality, or whether your wealth is tied up. In this video, I'm going to walk you through the biggest inheritance tax planning mistakes I see every week. Not edge cases, not theory, real situations that quietly dismantle estates. And at the end, I'll explain what actually works and why most people miss it. So stick around till then and don't forget to hit subscribe. Pitfall number 1, inheritance tax is only for rich people. That is one of the most damaging assumptions people make, is that inheritance in tax is only a problem for wealthy families. It isn't. It's a property owner problem. If you bought a house 20 or 30 years ago, particularly in an area where prices have risen, you may already be exposed without realising it. The inheritance tax nil-rate band has been frozen for years. House prices haven't politely waited. So you get families who have worked their whole lives, paid tax all the way through and never once thought of themselves as wealthy. Then someone dies and inheritance tax appears out of nowhere. The biggest mistake here is delay. People assume inheritance tax is something you deal with later. Later when retirement is sorted. Later when the kids are older. Later when there's time. Inheritance tax punishes delay, because the later you leave it, the fewer options you have. Pitfall number 2 is the £1 million allowance comfort blanket. This is usually the point where someone says, but we're fine because there's £1 million inheritance tax allowance. And that sentence is a giant red flag, because there is no guaranteed £1 million allowance. What people are actually referring to is a stack of allowances, each with conditions attached. And most estates don't meet all of those conditions. So let's slow this down properly. Step 1, the basic nil-rate band every individual gets. It's 325 grand, and anything above that is taxed at 40% potentially. No property requirement, no family requirement, that part is straightforward. Step 2 is the residence nil-rate band. There is an additional allowance of 175 grand, but you only get this if all of the following are true. You own a qualifying residential property, that property is left to direct descendants, children, grandchildren or stepchildren, and your estate is not too large. Miss any of those and this allowance disappears. In theory, one person could pass on 500 grand tax-free, 325 basic, 175 grand residence. Already conditional, already fragile. Step 3, where the million headline comes from, if you're married or in a civil partnership, unused allowance from the first death can transfer to the surviving spouse. So in the best case scenario, you get 325 grand times 2 and 175 grand times 2. That's where the £1 million figure comes from. But this only works if everything lines up perfectly, and in real life it often doesn't. Step 4 is the taper almost nobody plans for. Once an estate goes over 2 million, the residence nil-rate band starts disappearing. For every £2 over 2 million, you lose £1 of that allowance. By around 2.35 million, it's gone entirely. This catches out people who are property rich, asset heavy, and not remotely cash wealthy, which is most families affected by inheritance tax. How people lose the £1 million without realising. People leave the house to a trust or to a sibling or to an unmarried partner. Residence allowance is gone, or the estate quietly drifts over 2 million because of house price growth, pensions, ISAs or business interests. No one notices until the second death, or allowances weren't properly transferred after the first death because paperwork wasn't handled correctly. So planning inheritance tax around the £1 million headline is dangerous. It's conditional, it's easy to lose, and it's rarely checked properly. Pitfall number 3, we've got a will, so we're covered. This one comes up constantly. People say we've got a will, so everything's fine. A will does not reduce inheritance tax. A will just decides who gets what. It does not decide how much HMRC takes. I see professionally drafted wills sitting on estates with 6-figure inheritance tax bills underneath them. The family is shocked. They assumed the will handled everything. It doesn't. A will is about distribution. Inheritance tax is about funding. And that distinction matters more than people realise. Pitfall number 4, the liquidity disaster and the HMRC deadline. This is the point where most inheritance tax plans actually fall apart. Inheritance tax is due before probate finishes. And whenever I say that, someone usually responds with, well, surely HMRC just extend the deadline if probate isn't done. So let's deal with that properly. HMRC does not wait for probate because probate isn't how inheritance tax is calculated. Inheritance tax is self-assessed. What that means in practice is when someone dies, the executors have to estimate the value of the estate at the date of death. Property, bank, investments, business interests, everything. Those values are all submitted to HMRC on inheritance tax forms before probate is granted. That is where HMRC's figure comes from, not from probate finishing, not from assets being sold, from the values the estate declares. Once those figures are submitted, the clock starts ticking. Inheritance tax is due in 6 months after the end of the month of death, not after probate and not after funds are accessible, not when it's convenient either. People then assume HMRC will be flexible by default. They aren't. I mean, come on, they can't even get a self-assessment right. But what are we hoping for here? HMRC does not automatically extend deadlines because probate is delayed or assets are illiquid. Interest starts running regardless. Even where time to pay is allowed, interest still accrues. So any so-called extension is not breathing space. It's borrowed time at a cost. There is an instalment option for certain assets, mainly property and land, and those can be paid over and up to 10 years. But interest still applies. It only covers the tax linked to those assets, and anything else still needs paying upfront. Discretionary extensions exist, but they are not guaranteed, not quick, and not something you want to rely on when a family is under pressure. So what happens in real life? At the point HMRC wants paying, bank accounts are frozen, property hasn't been sold, business assets are illiquid, probate hasn't unlocked access yet. HMRC still expects tens or even hundreds of thousands of pounds in cash on a deadline with interest ticking. So families scramble, they borrow, they sell under pressure, they make decisions they never intended to make. This is how estates get dismantled. Not because there wasn't enough wealth, but because there was no liquidity at the exact moment HMRC demanded payment. Allowances reduced the bill. They do not create cash. So when should you start planning? Short answer first, because this matters. You don't plan inheritance tax by age, you plan it by exposure. Age just happens to be when exposure usually shows up. The right question isn't how old are you, it's do you own property? Do you have dependents? Do you have assets you can't easily turn into cash? Would your family struggle to find 6 figures quickly if you died? If the answer to any of those is yes, planning is already relevant. In your 30s, most people don't need full IHT planning yet, but this is when you should understand the rules. Get a basic will in place. Start thinking about who depends on you. No panic, no products, just awareness. In your 40s is where people start drifting into risk without noticing. Typically, by this point, property has appreciated. Pensions are building, kids exist, mortgages are reducing. This is the ideal planning window. Why? Because gifting options still exist. Health is usually fine, insurance is cheaper, and you've got time on your side. This is where good planning is quiet and cheap. In your 50s is where IHT planning becomes practical, not theoretical. By now, estates are often over thresholds. Allowances matter. The 1 million myth starts breaking down. Liquidity becomes an issue. And this is when modelling matters. Whole of life policies start to make sense. Mistakes become expensive. It's still very doable, but fewer options than what you had in your 40s. 60s and beyond is no longer about optimization, it's just about damage control. Planning still matters, but gifting is harder, insurance costs more, health underwriting matters. Mistakes are irreversible, and this is when families often say, I wish we'd done this earlier. And this is the real trigger point. The moment your estate would struggle to write a check to HMRC, planning should already be done. That's usually once you own property outright or nearly outright, once assets outweigh cash, once dependents exist, once your estate crosses basic thresholds, even quietly. Earlier is always better, but not for the reason people think. It's not about tax rates, it's about optionality. Earlier planning means more routes, cheaper insurance, less pressure, better outcomes. Later planning means fewer choices, more cost, more stress, more compromises. Inheritance tax is unforgiving to last minute thinking. Pitfall number 5. Gifting without understanding the rules. Gifting is often sold as the solution. Just give it away and survive 7 years. That advice causes more harm than good. The 7-year rule is misunderstood constantly. Gifts with reservation cash people out all the time, and HMRC is very good at spotting arrangements that don't stack up. I see parents gift property but still rely on it financially, or give assets away but retain control in ways they don't realise are taxable. When HMRC challenges it, people are shocked. They shouldn't be. Gifting can work, but only if it's done properly, genuinely, and with full understanding of the consequences. Otherwise, it's not planning, it's just another risk. Pitfall number 6. Trusts used as a panic button. Trusts are often treated as a cure-all. They aren't. Trusts can be useful. They can also be expensive, rigid, and badly implemented. Putting assets into trust does not automatically remove inheritance tax, and in many cases it introduces new taxes, ongoing administration, and restrictions people weren't expecting. A trust without liquidity is still fragile. Trusts are a tool, not a strategy. What actually works is planning for cash, not just value. Proper inheritance tax planning focuses on one thing above all else: liquidity at the point of death. You can argue with valuations, you can't argue with timing. This is where whole of life insurance written into trust becomes relevant, not as a loophole, not as a product push, but as a practical solution to a very specific problem. It creates cash exactly when it's needed, outside of probate, without delays, without forcing asset sales. The policy just pays out. The inheritance tax bill can be settled, the estate stays intact. We work with specialist partners like Caspian who structure these policies properly inside trust so the money goes where it's meant to go when it's meant to go. No chaos, no pressure decisions, no family panic. Inheritance tax planning isn't about avoiding tax at all costs, it's about avoiding chaos. If your plan relies on assumptions, goodwill, or the idea that the kids will just sort it out, it isn't a plan. If you've never actually modelled what happens when HMRC comes knocking and you're guessing with inheritance tax, it can become very expensive. If you want us to run the numbers properly and talk through sensible options, that's what we do. No hype, no scare tactics, just planning that actually holds up in real life. All the links are in the description, and don't forget to hit subscribe. Thanks for watching.